So you look at a company's financial report, and it's just a wall of numbers, right? But what if I told you there's a way to make those numbers talk, to tell you the real story about a company's health? Well, that's exactly what we're going to do today. We are diving into something called ratio analysis, which is basically like a secret decoder for any business's financial health report.
I mean, that's the big question, isn't it? How do you know if a company is genuinely strong or if it just looks good on the surface? You know, in the world of finance, numbers don't lie. But you only get the real story when you start comparing them to each other. And that simple idea is at the heart of everything we're about to explore.
Here's the best way to wrap your head around this. Think of it like a doctor's report, but for a business. Just like a doctor runs tests, checks your blood pressure, your vitals, investors use ratio analysis to give a company a full health checkup. It's literally a medical report that tells you if a business is in shape or not.
All right, so here's our game plan for this health checkup. First, we'll get to know our main tool. What even is ratio analysis? Then we're going to run 4 crucial tests. We'll start with liquidity. That's the short-term check. Then solvency, for long-term stability. After that, activity, to see how efficient the company is. And finally, the big one, the final scorecard, profitability. Let's get started.
Okay, so to do any kind of checkup, you need the right tools. And in our case, the most important tool in the entire kit is ratio analysis. This is our financial stethoscope, our X-ray machine. It's everything we need to see what's really happening on the inside of a company.
Now, this definition might look a little formal, but don't let it scare you. All it really means is that we take a couple of numbers from a company's financial reports, the balance sheet, the income statement, and we just divide one by the other to see how they relate. It's just a way of finding the hidden story behind all those numbers.
First test up is liquidity. And you can think of this one like when a doctor checks your temperature or your blood pressure. It's the first, most immediate thing you check. It tells us about the company's day-to-day short-term health. Super important first step.
So the liquidity test boils down to one very simple question. Can the company pay its bills right now? Does it have enough cash on hand or things it can turn into cash quickly to cover things like salaries, rent, and paying its suppliers on time? And the most common way to figure this out is with something called the current ratio. The formula couldn't be simpler. It's just current assets divided by current liabilities. So what are those? Well, current assets are basically everything the company owns that it can turn into cash within a year. And current liabilities, that's all the bills it has to pay within that same year.
Okay, let's look at a real example so you can see how this works. On the screen, you can see we add up all the current assets. That's stuff like inventory, cash, money that customers owe them. And we get a total of $134,000. Then we do the same for the current liabilities, like bills they owe to their suppliers, which adds up to $104,000. So we just divide the assets by the liabilities, and boom, we get a current ratio of 1.29 to 1.
Now, a ratio of 2 to 1 is often seen as the gold standard. What that means is for every single dollar of bills the company has to pay soon, it has $2 in assets ready to go. That's a really healthy cushion, right? Of course, the ideal number can change a bit depending on the industry, but 2 to 1 is a fantastic place to start. All right, let's move on to our second test, solvency. Now, if liquidity was like a short sprint, think of solvency as the marathon. This test isn't about today or tomorrow. It's about the company's long-term strength and stability. Is this business actually built to last?
And the biggest question solvency tries to answer is this. Is the company running on its own money, or is it heavily relying on borrowed money? Because, as you can imagine, a company that's drowning in debt can be a pretty risky bet in the long run.
To measure this, we use the debt-to-equity ratio. And again, the formula is super straightforward. It's just the company's total long-term debts divided by the shareholders' funds. Or, to put it really simply, it's a direct comparison of other people's money versus the owner's money. This chart here shows a fantastic situation. You can see the bar for equity, the owner's money, is way, way bigger than the bar for debt. This tells you right away that the company is mostly funding itself with its own capital, not by borrowing. And that is a huge sign of financial stability.
So the key takeaway here is really simple. The lower the debt-to-equity ratio, the safer the company is considered to be for the long haul. A low number just means less risk for everybody involved. It's as simple as that.
Okay, on to our third test, activity ratios. Think of this one as the company's fitness test. We're not just looking at money anymore. Now we're checking how efficiently the company is actually using its resources to make money. How well is this machine running?
Activity ratios answer a bunch of questions, but a really important one is this. How fast is the company actually selling its products? Is its inventory just sitting in a warehouse somewhere collecting dust? Because every unsold product is just cash that's tied up and not being put to work.
And for that, we use the inventory turnover ratio. This number tells us how many times a company sold through its entire stock of goods in a certain period, usually a year. And for this one, the higher the number, the better it is.
So for example, if a company has a ratio of 3 times, it means they completely sold out and restocked their inventory 3 times over the year. A high number like this is a great sign. It usually means sales are strong and the company is incredibly efficient at managing its stuff. Companies that sell everyday items often have insanely high ratios.
And that brings us to our final, and you could say our most important test, profitability. At the end of the day, after all the other checks are done, after every single bill and tax is paid, is the company actually making any money? This is it, the final scorecard.
We measure this with the net profit ratio. This ratio shows us the bottom line. It's the pure profit that's left after every single expense. We're talking interest, taxes, everything has been subtracted from the total money the company brought in, and we always show it as a percentage.
Here's the easiest way to think about it. The net profit ratio answers this question. For every $100 in sales, how many dollars does the company actually get to keep in its pocket as pure profit? So a ratio of, say, 20% means for every $100 of stuff it sells, the company makes a solid $20 in actual profit.
So let's do a super quick recap of our whole health checkup. Liquidity checks short-term health. Can it pay today's bills? Solvency checks long-term strength. Is it built to last? Activity checks efficiency. How well does it operate? And finally, profitability is the final score. At the end of the day, is the company winning?
So now that you have this toolkit, here's a question for you. If you were about to invest your own money in a company, which one of these 4 health checks would you run first? Which one do you think is the most important starting point? It's a tough one, and I'd love to hear what you think.